Hello traders. Welcome to another exciting episode of Easy Forex Pips. In today's video, we'll focus on maintaining profits and minimizing losses while taking low risk with high reward trades. Some traders think that a 1-to-1 risk to reward ratio is essential, but that's not always the case. If you use a 1-to-2 or more risk reward ratio, where you risk $5 to make $10, you can be profitable with less than a 50% win rate. Trading is largely a mental game, and confidence is a key to the success. Understanding these ideas is crucial for a successful career in the Forex industry. In this video, we will discuss how to approach single and multiple targets with any trading strategy. Plus, we'll share a unique tracking technique to help you find those incredible low-risk, high-reward trades. If you're eager to enhance your Forex trading knowledge and uncover exciting trading opportunities, please like this video to show your support. If you're new to our channel, consider subscribing as we regularly share advanced trading insights. Let's get started. Your success in trading depends on two important factors: your win rate and your risk-to-reward ratio. Let's explore these two crucial concepts in the world of Forex trading. First, let's talk about win rate. Your win rate is the percentage of successful trades. For example, winning 5 out of 10 trades means a 50% win rate. Many traders think a high win rate is the path to success, but it's not the whole story. The risk-to-reward ratio is equally important. It evaluates your potential return in comparison to the risk you're taking. For instance, if your stop loss is 10 pips and your target is 20 pips, it's a 1-to-2 risk-to-reward ratio. If you're willing to risk 3% of your capital, your potential gain is 6%. Lower risk-to-reward ratios work well for beginners, offering more wins and boosting confidence. Higher ratios let you ride out market fluctuations for bigger profits. Now, let's explore profit-taking strategies. The first method is, there's the approach of setting two profit targets. You close half position at the first target, lock the gains while letting the rest of the trade run. This saves your winning trade from turning into a loser. For example, if you achieve a 1-to-1 risk-to-reward ratio and close half of your position, you secure a winning trade even if the price reverses and hits stop loss. For example, if you open a trade with 1-to-1.5 risk-reward ratio and $1 per pips, you set two targets, first target at 10 pips and the second target at 20 pips. And if the market moves in your way, you close half of your position at the first target with 10 pips profit, so you will make $5. By the way, if beginner traders don't understand the calculations, I want to mention that, if you close the whole trade you will make $10 profit. Okay, now, if your second target gets hit you will make another $10, but if your take profit does not get hit and market reverse, and hit your stop loss, you will lose that $5 you have made from the first target. So, even that trade hit your stop loss, still it was not a losing trade for you. If you didn't close that half position at the first target, it would have been a losing trade. It's an effective way to protect your profits. There are more methods for implementing a profit-taking technique in your trading. Like, you can open two separate positions, each with half of your initial trade size. For instance, if you're willing to risk 2% of your capital, start two positions, each with 1% risk. Set a 1-to-1 target for the first position and a higher timeframe target for the second. This keeps your total risk at 2% and gives you two distinct positions. Another method is, consider using a fixed ratio like 1-to-2 or 1-to-3 risk to reward. A strategic approach is to identify higher timeframe key levels, which can be strong resistance areas based on past price rejections. If the price retraces to such a level, it becomes a higher timeframe target for your trade. Now, here's another strategy to protect your profits. When your trade reaches the 1-to-1 target, adjust the stop loss of the second trade to the break-even point. This ensures that you retain gains from the first winning trade. One of the best practice is to use trailing stop loss technique. A trailing stop loss is a tool in Forex trading that automatically adjusts your stop loss order as the market moves in your favor. It allows you to lock in profits while protecting against losses. Initially, you set a stop loss at a specific price level. As the market moves in your favor, the trailing stop moves along with it, maintaining a set distance from the current price. If the market reverses and hits the trailing stop level, the trade is closed automatically to limit losses. It's a dynamic way to manage risk and secure gains in trending markets. Let's say you're trading the Euro-USD currency pair, and you enter a buy trade at 1.1180. You decide to set a trailing stop loss at 60 pips below at 1.120. As the market moves in your favor, the trailing stop adjusts itself to stay 60 pips below the current market price. If the price keeps going up, your trailing stop continues to follow, always 60 pips behind. However, if the market goes at high point 1.320 and reverses back to and drops to 1.280 or lower, your trade is automatically closed, locking in your profits from the high point and limiting potential losses. In this way, the trailing stop allows you to secure gains while still protecting against adverse market movements. Keep adapting your stop loss as the price action unfolds. Avoid setting it too close to individual candles and leave room for potential retracements. Eventually, when you reach a higher timeframe resistance area, consider closing all your positions. Even if the market suddenly reverses, you'll still walk away with profits. Now, let's see some real chart example. We're looking at the GBP-USD pair on the 1-hour chart. We use a 50-period exponential moving average. The price has broken below this moving average, indicating a bearish trend. To go short, we can see a bearish engulfing candlestick pattern. We open 2 positions, each risking half of the desired trade size. The first target is a 1-to-1 risk-to-reward ratio, and the second aims for the higher time frame key level. This comprehensive approach blends various strategies to ensure our trading plan is well-rounded and adaptable to the ever-changing Forex market. Let's see how this strategy works in action. First, our trade reached the first target, giving us a winning trade with a 1-to-1 risk-to-reward ratio. The second position is still open. If you want to secure gains, you can move the stop loss of the second trade to break even. However, it's often best to leave the stop loss above the most recent swing high, as Forex markets can be volatile. Even if the price reverses and hits our stop, we still break even thanks to the profits from the first trade. At last, we've covered some important Forex trading strategies and tips to succeed in this dynamic market. These techniques help you set targets, manage positions, and capture high-risk, high-reward trades while minimizing trading stress. It's crucial to balance knowledge, practice, and the right tools. Every trader's approach is unique, so experiment and backtest to discover what works best for you. For more in-depth insights and tools, visit the links in the description. If you found this video helpful, please like and subscribe for more advanced trading knowledge. Best of luck in your Forex trading journey.